Let me walk you through what I'm seeing right now, because something unusual just happened in the silver market, and it's not getting the attention it deserves. Volatility in silver didn't just rise, it exploded. The volatility index tied to silver suddenly surged to 115. To put that into perspective in simple terms, the normal environment for this index typically sits somewhere between 15 and 40. When you see readings above 100, you're no longer looking at routine market noise. You're looking at stress, uncertainty, and the expectation of violent movement. And what makes this moment even more striking is this. The options market is now pricing bigger potential swings at current price levels around the low 70s than it was when silver was near its peak just weeks ago. That tells us something important. This isn't about where price is, it's about what participants believe could happen next. When markets expect calm, volatility falls. When they sense instability beneath the surface, volatility rises. And when volatility reaches extreme territory like this, it usually signals that something deeper is shifting structurally. At the same time, we're seeing a widening disconnect between physical and paper markets. In Western trading environments, silver is hovering in the low 70s range. Meanwhile, in Eastern markets, physical pricing continues to hold significantly higher, maintaining a strong premium. That divergence hasn't disappeared, even as futures markets have come under pressure. This is not the behavior of a simple bull market ending. This is the behavior of stress building underneath the system. Now let's zoom out, because the metals themselves didn't suddenly become weak for no reason. What we witnessed recently across the broader financial system helps explain the pressure. Equity markets experienced massive intraday swings, the kind you don't see in stable conditions. Trillions in market value were erased and then rapidly added back within hours. Moves of that size and speed aren't driven by calm investor repositioning. They're the fingerprints of forced liquidation. When large leveraged players begin facing margin pressure, they don't sell selectively. They sell what they can. The goal becomes raising cash, fast. And when that happens, even assets traditionally viewed as safe havens get hit. That's why we saw metals fall alongside risk assets. In a healthy market, stocks dropping often coincide with gold or silver strengthening. But in a liquidity-driven environment, everything gets sold at once. Fundamentals temporarily stop mattering. Liquidity becomes the only priority. That's exactly what we appear to be entering, a deleveraging phase. At the same time, signs of strain are beginning to show in the financial plumbing of the system. Quiet usage of emergency-style liquidity mechanisms suggests that some institutions may be feeling pressure behind the scenes. These facilities don't tend to get tapped during calm periods. They show up when funding tightness begins creeping in before it becomes obvious to the public. This aligns with what we're seeing in macro signals. The dollar has been strengthening. Volatility measures tied to broader markets have been rising. Bond yields have been declining. That trio matters. When all three occur together, it often signals a defensive shift underway. Capital seeking safety, hedging activity increasing, and expectations for economic slowdown quietly building. Historically, this combination has preceded periods of stress across equities, commodities, and credit markets. So instead of interpreting metals' weakness as failure, it may be more accurate to interpret it as collateral damage in a liquidity-driven unwind. We've seen this pattern before. When leverage expands across the system during optimistic periods, stability creates its own fragility. Positions grow larger, risk tolerance rises, and borrowing becomes the fuel for performance. But when something triggers selling, often unexpectedly, the unwind begins. And that unwind doesn't discriminate. High-quality assets and speculative positions get liquidated side by side. This phase is messy. Prices disconnect from fundamentals, and markets become dominated by forced sellers instead of willing participants. Right now, sentiment around silver has shifted dramatically toward fear. Many are declaring the move over after the recent correction. But from a structural perspective, emotional extremes often mark transition points, not conclusions. Bull markets rarely move in straight lines. They climb through doubt and retreat during stress. And beneath the surface, the longer-term drivers haven't disappeared. Industrial demand tied to emerging technologies continues expanding. Infrastructure tied to electrification and advanced computing still relies heavily on silver's unique properties. Meanwhile, supply constraints have been building for years, with deficits emerging between production and demand. That imbalance doesn't vanish simply because futures prices decline for a period of time. Another important element is positioning. Globally, silver still represents a very small fraction of allocated wealth compared to historical peaks seen during previous commodity cycles. That suggests there is room for capital rotation if confidence eventually returns after the current stress phase subsides, but none of this removes short-term risk. Liquidity-driven environments can push prices lower than fundamentals would justify. Technical support zones currently sit in the low 70s. If those levels hold, stabilization could occur and open the door for recovery toward higher ranges. If they fail, downside moves could extend further as selling pressure continues. And that brings us back to volatility. The spike in volatility doesn't tell us direction, it tells us magnitude. Markets are preparing for turbulence. Major economic releases and policy signals in the coming days may act as catalysts, not necessarily because of the data itself, but because such events provide opportunities for large players to adjust positioning. When volatility is elevated, price swings often become amplified. So what we're watching now is not simply a metal price story. It's a system story, a story about leverage being reduced, about liquidity becoming scarce, about positioning stress surfacing across multiple markets at once. And historically, periods like this create temporary distortions, prices that detach from underlying realities. Eventually, forced selling exhausts itself. And when it does, fundamentals tend to reassert. That doesn't mean volatility disappears overnight. It means the environment transitions from panic-driven movement to opportunity-driven repositioning. For now, uncertainty is dominant. Volatility has already confirmed that the next phase won't be quiet. The real question isn't whether turbulence is coming. It's whether observers understand what kind of turbulence this is. Because when markets move under the pressure of liquidity rather than logic, price becomes less about value and more about survival. And once survival selling ends, the landscape often looks very different than it did at the bottom of the storm.